So you haven't been able to get consistent in your trading, you haven't been able to scale your trading, and you haven't even found an edge. That's all because you haven't found a quantitative approach to your trading. These days, it's absolutely essential, and that's exactly what we're going to talk about on this episode of the Independent Quant Podcast, Episode 3, What is Quantitative Trading? So let's jump on in. So in this episode, we're going to talk about what quantitative trading is and how it works, the key differences between quantitative trading and discretionary, why traders struggle without a systematic approach, and what you can do today to get started with quantitative trading. So first, what is quantitative trading? So quantitative trading is using a rule-based approach to trading. The way you develop those rules is by way of statistical analysis and using historical market data to determine if you have a strategy that has edge. So that has several parts to it, and how do you kind of break that down? First, you need to be able to collect data and analyze that data. It's not simply limited to market data, but that's where we'll start. So you get connection to either a broker or some other data source. Let's just say you're doing it through your broker. One of the easiest ways to do this is using your broker software to be able to pull that market data straight off their platform. If you're a little more advanced, then you're probably able to get data from other sources. Those other sources may be news, social media. Today, quantitative trading, really any type of data is fair game, but you need to be able to collect that data and analyze it in some way. Try to find patterns and trends. Sometimes we're not even just looking at price, but trying to determine how one feature, that's some type of variable that's in the data, how that maybe you can use a collection of those to identify another feature. And maybe that's the approach you take to developing a trade and not really looking at the price. Analysis can cover a lot of that. Now, once you feel that you've arrived at a system or a good model that you want to implement, how do you know if that model is good for trading? Well, the way you approach that is by way of backtesting. This is one of the big things that sets quantitative trading apart from others, is that we can take that strategy that you just developed, the idea that you've analyzed, and actually run it over historical data. Now, it should be done within historical data that should reflect the market conditions that you're about to put that strategy into. But in any case, you are able to test that strategy and see, is it profitable or not? That's usually the first thing we care about as traders, is can we turn profit using this? But right on its heels, at least when we're developing these strategies, is how much risk do we have to take to execute the strategy? What are the drawdowns? What is the maximum loss? What is the average loss? How big of an account would I need to do to execute this strategy? All of that can be answered by way of backtesting, and that's one of the big pillars of quantitative trading. So with using that data collection, those backtests, you're able to further refine your strategy and develop other strategies off of strategies that you've found successful. And once you arrive at something that you're comfortable taking to the markets, I highly suggest that traders validate any strategy they do, be that an algorithmic one or a systematic one that they've developed by way of just trading in simulation, seeing how that strategy actually would work using live data instead of historical data. What you'll find is a lot of platforms, they operate differently. They calculate information and data differently. If it's coming from a historical source, they're probably just using open, high, low, while if they're using live data, the platform may be calculating by the tick. If you don't know what those mean, just head on over to one of our courses and we'll kind of delve into what all that matters. But that's beyond the scope of at least this introductory podcast here. But let's say now you've made that assessment. You've validated, you've backtested, you've got a strategy that you're comfortable with. It's not required in quantitative trading that you automate the strategies that you develop. However, for the independent quant, I'm making the assumption that your goal, like mine, is to develop an algorithmic trading desk. So that ultimately means that you have an algorithm that's going to send the orders in for you and manage your trades. So we're going to say that that is an integral part of quantitative trading for the sake of this podcast. So once you've hit that point, now you've got an algorithm that's executing and managing all your trades. The beauty of quantitative trading is that it also allows you to monitor your performance and optimization. Now, truthfully, you could do that with other strategies, whether it's systematic or not, but The beauty is now you can take the data that you're getting now, the performance that you're getting now, and compare it to your back test and try to assess is it comparable or are they different and why, and make a decision based off of that. So a lot of that is getting to the point where you have a rule-based approach to trading where you're removing emotion and you have a way to assess how profitable you could be if you're using a specific strategy. So that is what quantitative trading is in a nutshell. Now, quantitative trading here at the Independent Quant, I take a very broad definition for quantitative trading. If we go by very strict definitions, quantitative trading is using statistical methods and historical data to develop strategies. I broaden that a little bit more in that if you're a systematic trader that uses some type of code to arrive at a rule-based system, then you're a quant as far as the independent quant is concerned. Again, whether or not you implement that algorithmically is not a focus of ours here, but we're making the assumption that you are implementing an algorithmic strategy. In contrast to everything I said there, there was three parts to that: quantitative trading, the statistical part. Then there's systematic trading, which is having just a rule-based system. That's what I've done up until the point of this recording and I've dabbled into algorithms, but now I'm building an entire algorithmic trading business, right? So you've got quantitative trading, statistical, then you have systematic, which is rule-based, and then there's a part there where it's algorithmic trading, which is really those first two put together and implemented automatically. If we were to group all those, there is a other, which is what a lot of traders find themselves doing, which is discretionary trading. Discretionary trading is when we take orders or make orders or manage trades by way of gut reaction, intuition, not using a data-driven approach. That is very risky because it depends on your emotions and how you're processing information that day, and it's emotion-based decision making, which is really not what we should be doing as traders. We want to have an edge that is repeatable. Our emotions really disallow us from having a repeatable way to approach the market. Additionally, with discretionary trading, it's not very scalable because typically it means that you are in front of the computer. You have to assess every trade condition. You have to manage every trade. Not where we want to be as quantitative traders. With that, lastly, you can't validate your strategy objectively. Because there's so much emotion and intuition, as some discretionary traders would probably call what they're doing, not emotional, but rather intuition. The problem with that is it's not really testable because you don't know how you would have reacted or how your strategy would have performed over time because you don't know what your emotions would have been at any of those given moments. So it removes our ability to assess a strategy objectively, and which is not where we want to be. We want to be on that quantitative, systematic, algorithmic realm. It removes emotional bias. It allows us to scale successful strategies and find other strategies that we know can get consistent execution over time, and that consistent execution is validated because it's been back tested using a very data-driven approach. Now, why do traders struggle with quantitative trading, especially if it's supposed to be this great thing where emotions are removed from trading? Well, I'll tell you from myself, the very first one is it doesn't completely remove emotions. Emotional trading does lead to poor decision making. Just because you've placed an algorithm on it doesn't mean that you've completely eliminated emotion. In many ways now you've become a supervisor, which is the way I see myself as an algorithmic trader, is that I'm supervised. What in the past would have been an employee now is an algorithm that's trading on my behalf. Well, it's hard when you have your own money out there and you've got an algorithm, even though you've trusted it because you've run all these back tests, you still want to see it work, right? And if you're seeing it work, you may be emotionally inclined to intervene in its trades, right? And that is just not advisable. That's the whole point of why you didn't want to be a discretionary trader and why you chose to be a quantitative trader, was to have this systematic, rules-based approach that doesn't get intervened. Well, that's something that we have to condition ourselves to if we want to be quantitative and algorithmic traders, is we have to develop confidence in the algorithms that we build and the strategies that we develop, and letting them run their course. Because if we don't, we'll find ourselves getting inconsistent results. And every time you interfere or deviate from a strategy, the reports that you're getting as far as the performance of that strategy is now suspect. You can't rely on that information anymore because that strategy was never actually implemented. You interfered with it. You did something completely different than what was supposed to happen. So the backtest will not match the real world results. If quantitative trading is something that sounds very appealing to you and something that you'd want to delve into, then the way to kind of get yourself started in it is you want to learn the basics of the markets and quantitative models. You want to learn how to develop a rule-based strategy, and you want to learn how to backtest that strategy because it's going to be dependent on what resources you have as to how that backtesting is going to take place. Along with that, it's also going to be dependent on how you automate and execute your strategy. So if all of that sounds really appealing for you, then we do have a mini course at the Independent Quant where you can dive in and just get a 30,000 foot view of what quantitative trading is. If you're ready for the next big steps and want to get an algorithm created and at least validated within 30 days, we do have a course available that expedites and gets you to that point. With that, thank you so much. This is Luis from the Independent Quant. I look forward to seeing you at the next podcast.